Hi guys, welcome back to Father and Son Investing. Today's video is the November 2023 Treasury Bill update. And quite honestly, not a lot has been happening in terms of Treasury Bill yields. In fact, what I have before you here is in red what it looked like at the end of September, and in light blue what it looks like as of October 27th. You'll notice that not a lot has changed, except for here at the 1 year where we see that rates have come down a bit since the end of September. Today's video is going to be highly centered on what might be happening for your Treasury bills in the near future. In fact, there's an important date coming up, November 1st. All of you may be thinking that I'm thinking about the FOMC meeting, the Federal Open Market Committee meeting, or the Fed meeting, which will give their recommendations on November 1st. However, that's not what I'm talking about. Also on November 1st, the U.S. Treasury will be making an important announcement about what their upcoming funding needs will be and just what their issuance will be in terms of Treasury bills, notes, and bonds. We're going to start this video by going back to the last quarterly refunding statement from the U.S. Treasury. That occurred on August 2nd of this year. And before we get into the actual numbers, I want to show you the first paragraph here, which is a little bit startling to me. This first paragraph says the U.S. Department of Treasury is offering $103 billion of Treasury securities to refund approximately $84 billion of privately held Treasury notes and bonds maturing August 15th. They're going to issue $103 billion worth of securities so that they can pay off $84 billion worth of privately held Treasury notes and bonds. In fact, they're only getting $19 billion worth of new money out of this $103 billion that they're going to be issuing. To me, that is startling and scary. Now, they issued a little chart here so that we can see just how much the Treasury was going to be increasing their size of their auctions. This is for the Treasury notes and bonds, not the bills. We'll get down to bills here in just a minute. But notice here that we'll use the 2 year as an example, $42 billion is what they had been doing each month, and they increased that significantly each month such that in October they were up to $51 billion of 2 year notes for the full month. We'll see that the same is true for these shorter term notes here. The longer term Treasury bills, that was not really happening. And in fact, this is a little bit curious because, of course, back in August, the Treasury bond yield and 10-year Treasury note yield was actually significantly less, of course, than it is now. So curious that the Treasury didn't have that foresight. When it came to Treasury bill issuance, they didn't give any firm guidance. They just said Treasury anticipates further moderate increases in Treasury bill auction sizes in coming days. Now, that's significant because they'd already increased the Treasury bill auction sizes starting back in June when they were refunding the government. In fact, let's just take a look at this graph, which shows us two things here. In gold, we have the U.S. 10-year Treasury yield, and in blue, we have the 10-year Treasury yield term premium. If you're not familiar with what term premium is, just understand that it's the extra amount of interest that an investor expects for locking up their money for a longer period of time. We'll notice that both of these have just spiked since that August announcement. Now, there are lots of factors that can go into what Treasury yields are, but I think that this increased funding by the government was certainly one part that played into this spike in Treasury yields. So on November 1st, the U.S. Treasury will be issuing their next quarterly announcement for what they expect to be issuing in the next 3 months. We're going to want to pay close attention to that. Potentially, we could see another spike here in yields if that amount goes up significantly. Now, with that background in mind, I want to start steering the conversation towards Treasury bills in particular here. To do this, I'm going to use a couple of graphs. Imagine that, me using graphs. I want to show you this one here on the bottom with this line in blue that is declining. Just what is this line? Well, it's the amount of money that's being kept overnight at the Fed's reverse repo facility. If you're not familiar with this reverse repo facility, just know that it's the Fed's way of being able to loan money in between banks or other institutions. They keep this money there overnight, and they offer these institutions some interest there so that they can then loan their money. So the interest rate at this overnight facility had been about 5.1% back in May and June. And because it had such a great rate, and really Treasury bill yields had not reached this high, or at least had not exceeded this, a lot of money from money market funds was being stored there. I mean a lot of money, like $2.5 trillion worth of money was being stored there, a lot of it which was from money market funds. Now, you'll notice that this line here starts declining really around the beginning of June, and it just keeps on declining. Well, what was happening back at the beginning of June? You'll recall that that was when the debt limit crisis was coming to a head, and of course the politicians did what all good politicians do. They kicked the problem down the road. And when they did that, that allowed the Treasury to start refilling its coffers. To do that, they started issuing a lot of Treasury bills, and as they issued more Treasury bills, supply and demand, the yields on those Treasury bills went up because the price on those Treasury bills went down. As the yields went up even better than what the overnight reverse repo facility was offering, the amount of money being stored in this facility has been declining. In fact, it's about half of what it used to be back in May and June. We're down to about $1.09 trillion there. So this has taken up a lot of liquidity. What am I talking about here? Well, before these money market funds were parking money at something that they could easily get their money out of. It was just an overnight facility. Now they are locking up that money for longer periods of time. In fact, the shortest Treasury bill obviously is 4 weeks. And so the term, the total term within these money market funds has increased from something that was really a daily amount to something that's now quantified in months potentially. So let's just recap where we've gotten to so far. We know that the Treasury is going to be making an announcement on November 1st. But the last time the Treasury made an announcement for their quarterly funding on August 1st, it has played part in spiking up the yields on U.S. Treasuries. We also know that this money being held at the overnight repo facility has been declining significantly, drying up liquidity within our financial system as the money market funds essentially expand the term on their holdings because they're getting a better yield now from Treasury bills. Let's then talk about Treasury bills in terms of where they sit in terms of overall U.S. debt, what's the recommended amounts, and what we can expect in the near future. So there is actually a committee that determines what the recommended amount is, and that is between 15 and 20% of overall U.S. debt. That's how much of it should be consumed by Treasury bills. We'll notice that there are times when it's much greater than 20%. In fact, during the first part of the century up until about 2010 or so, it was more than 20%. This, of course, was when the great financial crisis hit and then issuance of Treasury bills spiked. Then we'll notice this long period where it was actually below the 15% recommended level. That's when interest rates have been extremely low. And then we see this spike here in 2020 when the pandemic was going on and the Treasury was issuing a lot of Treasury bills. Then we see this nice drop here, and then starting roughly in June of 2023, we're going to see this spike here as the U.S. Treasury has issued more Treasury bills. This last part here in light blue is what the Treasury bill, expected Treasury bill issuance is. And we'll notice that it's going to be 20%, at least according to this, well out into July of 2024. This top part here shows remain elevated through fiscal year 2026, which starts in 2025. So recapping to this point, again, announcement coming out November 1st. The last announcement had a big spike in Treasury yields. We've seen that the overnight repo facility money has been drying up, decreasing liquidity in our market. And we see that it's expected that the Fed will issue even more Treasury bills out through fiscal year 2026. Now, before we get to the next part of the discussion, I want to discuss the top half of this graph here. And we'll notice that while this is going down, this has been going up. What is the top half of this graph? Well, it shows the 3-month Treasury bill yield compared to something called the OIS. What is the OIS? OIS stands for Overnight Index Swap. It is a type of interest rate derivative. We're not going to go into what derivatives are here, but an interest rate derivative. And it reflects what the market expectations are for future overnight interest rates. Now, unlike Treasury bills or even the overnight repo facility that the Fed runs, the OIS rates are not directly controlled by the central bank. They are based on market forces and the expectations of future interbank lending rates. So the OIS just reflects what the market thinks the interbank lending rates will be in the future. Remember, Treasury bill rates can be thought of as a reflection of what interest rates are in the present, of course, because how the Fed changes their rates directly reflects what the Treasury bill rates can be. So if we take the 3-year Treasury bill and we subtract out the OIS, the overnight index swap rate, that will give us the spread between those two. Now this will tell us some things about what the market expects in the future. If the spread is positive, like it has been recently, that will suggest to us that the market expects interest rates to rise in the future, or at least not decrease anytime soon, in my opinion. However, if the spread is negative, well, that's going to tell us that the market expects interest rates to fall, and that would indicate easing of monetary policy, i.e. the Fed decreasing their rates. So just recapping to this point, November 1st, there will be a quarterly announcement from the U.S. Treasury indicating just how much they're going to increase their debt issuance. Trust me, they're going to increase their debt issuance. They're going to have to in order to fund all of this federal spending, debt spending actually. The last time they made their quarterly funding announcement, we've seen a huge spike in that 10-year Treasury note and really in other Treasury note and Treasury bond yields. Meanwhile, all of this Treasury bill issuance has driven down the rate at the Fed's reverse repo overnight facility, which has helped dry up liquidity in the market as money market funds have increased the term of their holdings. Additionally, what we've seen is that the spread between the 3-month Treasury bill and the OIS, the overnight index swap, has increased here. It's gone from negative to positive as this has dropped. And this tells us that the market thinks that interest rates will be going up, or at least in my opinion, not dropping anytime soon. This tells us something about the future. Now let's go ahead and try to wrap all this up and tie it in together with the discussion that I've had. With all of this basis, I think then that this will make sense. Quoting from this Reuters article issued on October 27th, U.S. term premium shock may need T-bill surprise, we'll see here that it says, historically, the Treasury is not known to be reactive to market conditions or yield levels. However, the recent rise in yields and term premiums has been sharp. They go on to say, we expect more T-bills in the coming quarters versus what we had expected earlier. Why would that be? It goes back to this term premium that I talked about earlier. This increase in the amount of money that investors expect beyond just the risk-free rate in exchange for giving the government their money for a longer period of time. As this term premium goes up, this costs the U.S. government, the U.S. Treasury, a lot more in financing costs. They're paying extra now in order to sell their debt. One way of trying to get around that would be to sell fewer Treasury bonds and notes and start increasing Treasury bill issuance, at least in the short term. Now, this is a little bit risky because if interest rates go up even more, well, this term premium may go up even more and bond yields go up even more, and the government in the end ends up spending even more money to finance their debt than they would have if they'd have just issued Treasury notes and bonds. Now, what does this mean then for your Treasury bills? Wrapping all of this up, expect more Treasury bill issuance, more than had previously been expected, because the government is trying to avoid paying this term premium to investors on their longer term notes and bonds. And expect that as this liquidity here in the market, as a reflection of the amount of money held at the reverse repo facility, as this continues to dry up and as the Treasury continues to issue more Treasury bills, know that Treasury bill yields may rise. Will they rise a lot? No. In fact, the expectation is about 5 basis points, but it certainly could go higher depending on how hard or how much the Treasury needs to work to sell their Treasury bills. Now, I hope this information was useful for you. I hope this is information that you're really not getting elsewhere. I want to be able to give you something that is of value. If it was, please give us a thumbs up and share this information with somebody else. And until next time, as always, enjoy your investing.